as price starts getting close, you have two choices to make. You can either put a limit order here and hope that this fair value gap holds, or you can wait for a reaction and trade on the right side of the V, as it's called. So you put your limit order here. Where are you going to put your stop? That is the question, right? Where to put your stop loss. You don't have a swing low to put your stop loss under. So let's just say you know that fair value gaps often get wicked through. We're going to decide to put our stop loss a few points below the fair value gap. Price comes into here, and as it's coming in, you got put into the market, and you're hoping that this holds, that it does not wick down below there, and then boom, you stopped out. Now imagine that you knew about the right side of the V. You patiently wait for price to come up into the fair value gap. You wait for a retracement down, and then you see a swing low formed inside the fair value gap. This is going to be usually a low time frame, but it can be on any time frame. Now you're going to market order in here. And then price moves up, but before price moves up, you know where to put your stop loss, right? Because we know exactly where we're wrong. We're wrong if price goes below the wick, that wick through the fair value gap. Now, comparing the two, which one got a better entry price? Market order did. Which one is risking less? Market order is. And you could even get a tighter risk if you drop down to lower time frames and find a down close candle here, because down close candles will be acting as support once a swing low forms. So what is the upside of trading with limit orders? The only upside is you get less slippage with limit orders, and it allows you to get in the exact price you want. But how much is that slippage? Futures, it is at most a tick or two. With Forex, it can be a little bit more expensive. One lot can be $15 or more. But how much did that stop out cost you? $300, $200, somewhere around there? You have to weigh the risk versus reward. Is it better to have a higher win rate, not get stopped out? What I'm saying to you is take the small slippage to win more trades, to know where to put your risk, know where you're wrong, and get a better entry price. To me, trading with limit orders, if you don't know about trading on the right side of the V, because this is the left side of the V, the right side of the V. Trading on the right side is better, right? So if you don't know about, that's fine. But if you know about trading on the right side of the V and you're still trading with limit orders, two of three things are happening. You're being impatient, or you're not at the charts at the time. So if you're not at the charts at the time and you work or something, that's a whole different game. But if you're at the charts, this is the way you should be trading. Is it for everybody? Probably not. But I think the majority of people would benefit from trading this way. Better entry price, smaller risk, or exactly where you're wrong. This is guessing. You're hoping that price respects this fair value gap and doesn't keep going down. On the right side of the V, we know after seeing the fair value gap being respected, we know from our market study that it is likely to continue going up, at least giving us a scale out. Let's go look at an example in a chart. This is actually a trade I caught today on Friday. Turtle soups are a good example of why trading on the right side of the V is very important. So as price comes down, how in the hell do you trade this without market ordering in? You could set a limit order a certain amount of ticks or pips below here, right? But it's guessing still. You don't know where to put your stop. You don't know how far price may continue down to clear out these equal lows. So you really don't know. You could wait for price to move up in another fair value gap form, and then put your limit order in a new fair value gap, guessing once again. The way I do this is once I see price come down, wick into it, I am on the 3-minute. Turtle soups, I will drop down even lower. Let's go to the 30-second chart. Yeah, I know what you're thinking, the 30-second chart, like what in the fuck? But it does have its advantages. I actually got it from watching ICT using it. So I went and paid for the Pro Trading View, and it has been working pretty well. See how price is coming into this fair value gap here, and then it rejects it. I'm going to wait for this to be broken. This is an intermediate term market structure shift. This is an ITL that formed because it filled a fair value gap. It becomes an intermediate term high. Once I see that broken, I'm going to go long. Okay, it has been broken. We already know exactly where we're going to put our stop, don't we? And there you have it. So we traded on which side of the V. So here is the left side of the V, and then there is the right side of the V. Price coming down is being impatient, not knowing, and penny pinching on slippage. Trading on the right side of the V is being patient, proper risk management, and being a smart trader. Hope this video helps you guys trade better. This really changed the way I looked at price and the way I traded all the way around. This is not my concept. I'm not sure who came up with it, but it was a game changer for me.